Welcome to learning objective number 5. Now, we've already looked at a series of transactions for Circle Films earlier in today's workshop. What I would like to do now is I would like to go through the process of formally recording these transactions using the debit and credit system and using the journal entry standardized format that we just looked at in the prior learning objective. Now, before we do this, I want you to make sure that you've thoroughly reviewed and you're aware of first the accounting equation, which we've been covering over the last few weeks, and you're aware that to increase assets, you debit, and to increase liabilities and equity, you credit. You need to know that first, and you also need to know when you record accounting transactions, right, that from an accounting perspective, you put the debits on the left and the credits on the right, and consistent with that, when you record transactions, you have debits on the top and credits on the bottom, which are indented to the right. So, if you're up to speed with that, let's now start with learning objective 5. Now, in learning objective 5, instead of talking about increases and decreases in particular accounts, we are going to talk about debits and credits, right? Now, whether debit or credit is associated with an increase or decrease, as I just showed you with the accounting equation, depends on the nature of the account we're looking at. So let's go through all the transactions that we looked at for Circle Films, and let's formally record those journal entries so you're aware of how to record accounting transactions. Let's start with transaction number 1, where Circle issued 3,000 shares for $15,000 cash. Now, in this particular case, you know that cash is increasing by $15,000. So we have to record the journal entry, and the first thing that we start with in every single journal entry is the account or accounts that we are debiting, right? So you debit cash by 15,000 because cash is an asset. To increase an asset, as you can see on the piece of paper with your accounting equation, you debit that asset account. The business is also increasing contributed capital, which is an equity account. And again, referring back to your piece of paper with the accounting equation and the debit and credit notes on it, you can see that if you increase equity, you credit. So we credit the contributed equity account. Now, what we're seeing here below this is the transfer of these amounts to the relevant T account. So we start with transferring 15,000 increase in cash, which is a debit, to the debit side of the cash T account, and a 15,000 increase in contributed capital to the credit side of the contributed capital account. Now, what I want to do now is I want to move on to transaction number 2. Before we do that, I want you to have a go at it. Now, this is the question here. It says, what's the journal entry? Transaction 2, which is what we looked at earlier in today's workshop. It says Circle purchases a video camera for $9,000 and memory cards for $1,000. I want you to now indicate in the question that will appear which of these is the correct way of journalizing this accounting equation. So transaction 2, what did you record? Well, Circle was acquiring 2 assets, equipment and supplies. So therefore, those 2 asset accounts are increasing. So we debit those 2 asset accounts when we record this journal entry. Circle was using an asset, which is cash, to fund this particular transaction. So cash is being used up and cash is decreasing. So to decrease an asset, we credit cash, which is why cash is credited on the bottom of this transaction. Now, if we go down and we have a look at our T accounts, what you can see here is all the amounts that are highlighted are the amounts we have added to these T accounts as a result of the transaction that we have just recorded. So cash decreased, credited by 10,000. So we add it to the credit side of the cash account. Supplies went up 1,000. Equipment went up 1,000. Equipment went up 9,000. So therefore we input those amounts on the debit side of each of these asset T accounts. Let's move on to transaction number 3. So in transaction 3, Circle films a wedding for 1,500 cash. So how do we record this transaction? Cash is obviously increasing, so we debit cash. Service revenue is also increasing, so we credit service revenue. So the reason why we debit cash should be fairly obvious to you now. The reason why we credit service revenue may be less obvious to you. Now, what do you do with a revenue account if you want to increase it? You credit that account. And the reason why you credit it is because the business is earning revenue. Therefore, that is increasing the value of the business for owners. What do we do when we look back at our accounting equation if we want to increase the equity of the business? There's our accounting equation again. We credit. So consistent with that, if you are receiving revenue, you credit the revenue account. Okay, again, down the bottom, the highlighted numbers are where we have inputted this journal entry into our relevant T accounts. So if we look at transaction number 4, transaction 4 says Circle receives 2,000 to film a future reception. So this is where a customer is paying in advance for the service. So Circle receives 2,000 cash, which they debit, which if we look at the T account down here, increases the value of that T account. And they have incurred a liability. Now, going back to your accounting equation where you've noted down the debits and the credits, if you increase a liability, you credit that account. And that's what we're doing here. And that's what you're seeing there in the T account for unearned revenue. One more transaction that I'm going to go through before I'm going to get you to do another exercise. Transaction 5, Circle pays $250 cash for advertising. So in this particular transaction, we can see that we are debiting the advertising expense by $250 and crediting cash for $250. Now, again, the cash part probably looks reasonably straightforward to you. You're using up your cash, so you're crediting it, and that credit is obviously decreasing the value of that asset account. Why do we debit advertising expenses, and why do we debit advertising expenses? Let's go back to the logic that we used with revenues. So if you want to increase the value of the business for owners, you credit the equity accounts and you credit revenues because that's resources flowing in, increasing the value of the business. Expenses are where you're using up resources and decreasing the value of the business. So therefore, to decrease equity, you debit. To recognize an expense, which is decreasing the value of the business for owners, you debit the expense account. So all expense accounts are always debited in this particular journal entry format when you're increasing those expense accounts. Let's now look at transaction number 6. So what I would like you to do now is to answer the following question, which says, Circle films a dance competition, leaving a $3,500 invoice with the customer. So I would like you to tell me what you think the journal entry should be in this case. All right, so let's have a look at transaction 6. So it says Circle filmed an event for $3,500 and leaves an invoice with the customer. So in this particular case, the business is receiving a commitment from the customer to pay $3,500. So that's what we refer to as an accounts receivable. The business has a receivable from the customer. Now, the revenues that the business has earned from this is $3,500. So we credit service revenue consistent with revenue increasing the value of the business and the fact that you credit equity to increase the value of the business, which is why service revenue is credited there. So the amounts highlighted down the bottom in the T accounts relate to the transaction above. Let's move on to transaction 7. So transaction 7 says Circle buys another camera by signing a $9,000 note payable. So as we discussed last workshop, a note payable is a short-term loan. So the business in this case has received $9,000 of equipment from the supplier. So of course we debit the asset to increase the asset account accordingly. And we credit the liability because obviously the liability is increasing. Again, down the bottom highlighted is the increases in the T accounts associated with this transaction. So let's move on to transaction number 8. And before we go through it, I would like you to indicate what you think the journal entry should be in this case. So it says Circle receives $3,500 from the customer in payment of the open invoice from transaction 6. So that was where the customer was left with the invoice and it was expected that they were going to pay at some point in the future, which they have now done here at the time of transaction number 8. So please indicate in the following question what you believe the correct answer is. So if we have a look now at transaction number 8 and the correct answer, so because the customer has paid $3,500 with cash, we of course increase cash by debiting cash, and the customer has met their obligations, so the business no longer has that account receivable, so we credit asset accounts to reduce them. So as you can see there, the accounts receivable account prior to this transaction was $3,500, which was consistent with the expectation that that customer would pay at some point in the future. They do actually pay at the time of this transaction $3,500. So therefore, after you deduct that credit amount, you are left with an accounts receivable of 0. Moving on to transaction 9. So transaction 9, what we see here is that Circle pays $2,000 in wages to employees. So wages are an expense. So expenses is where the business is using up resources and therefore decreasing the value of the business. So we debit the expense account by $2,500. Specifically, we want to clearly say that we are debiting wages expense. So remember, whenever you record an accounting transaction, make sure the account is specific as to the nature of the expense that is being incurred. So if it's wages expense, you debit wages expenses. If it's electricity expense, you debit electricity expense, and so on. The business is paying in cash, so therefore we decrease the cash asset by $2,000 by crediting cash. And that's where that's indicated down the bottom here, the increase. So if we look at the wage expense account down the bottom, you can see that the amount highlighted is equivalent to the amount of expenses that have been incurred in this transaction and are therefore increasing the balance of the wage expense account. Moving on to the last transaction we have here. So it says Circle pays $1,500 in dividends to its owners. So the dividends are where you're taking money out of the economic entity and you are paying that to the owners who are outside the economic entity. So accordingly, you debit the dividend account. So because dividends relates to amounts that are being paid to owners and taking out of the economic entity, they are, of course, decreasing the value of the economic entity for those owners. So therefore, by debiting dividends, we are reducing the value of the business. So if we go back to the accounting equation that you wrote on your piece of paper, you see on that equation that if you credit equity, you are increasing equity. So therefore, you debit dividends because that reduces the value of the business for owners. Now, if we look at how they paid out those dividends, they obviously paid them in cash. So therefore, you reduce your cash by crediting cash. So that's the last transaction we're going to look at today. Now, what we want to do is we want to summarize all the final T account balances in the trial balance. And as I mentioned earlier, the trial balance is where you want all the debit accounts to equal the balance of all the credit accounts. And what you can see here is they do. So the sum of all the debit account balances is 31,000 and the sum of all the credit account balances is 31,000. Now, if we go back to the prior slide where we had transaction 10, you can see at the time we recorded transaction 10, we had a balance of $8,250. So this is the final balance of cash when we put together the trial balance that you see here. So we have cash of $8,250. And if we go back to transaction number 10, you have there cash of $8,250. So all the trial balance is doing is taking the final balance of all the T accounts, cash, dividends. If we go back to the prior slides, we had wages, expenses, accounts receivable, and it is listing all of those and including the final balances in the debit and credit columns as relevant. So what can we do with this trial balance now? Well, I'm going to ask you a question. I want you to tell me, based on this trial balance, what is the profit this business has generated for the period? So what we can see here, if we look at this trial balance, you can see that the service revenue and expense accounts are all grouped together, and I have a red box around these accounts. And simply the difference between service revenue and your expenses, so service revenue minus all your expense accounts is going to give you the value of profit for the period. So if we jump to the next slide, which shows our income statement, so if we jump to the next slide, what you can see there is we have service revenue, wages expense, and advertising expenses, and that gives you a profit of $2,750 for the month ending March 31. So you're simply, in this case, able to copy and paste these accounts out of your trial balance into your income statement to give you the information you need in order to determine your profit. Now, if you would like then to determine what the changes in your equity are for the period, then you use the profit that you calculated in the income statement above here. You then look at what dividends were distributed to the owners, because obviously that profit is not retained. It's distributed back to the owners, $1,500, and you copy that information into your changes in equity statement. So statement of changes in equity. And specifically, we're looking at the retained earnings change here. So this business started on March 1 with $0 in retained earnings, generated profit of $2,750 as we just saw, distributed $1,500 in dividends, and therefore was left with retained earnings of $1,250. Now, the last step is to look at what our balance sheet is for this business at the end of the period. And again, we go back to our trial balance and we see what the final balances of the asset, liability, and equity accounts are. And I have included the red box around these asset, liabilities, and equity accounts, which you then copy and paste into your balance sheet and include the final retained earnings, which you calculated in the changes in retained earnings statement or changes in equity statement that we looked at a couple of slides ago. And that's all the information that we're going to be going through in workshop number 3. So we've basically looked at transactions today. So if I go back and look at our initial learning objectives, the key thing that we focused on here was the debit and credit system, how to record these accounting transactions using the debit and credit system, and then consolidate that information into our ledger accounts, which is basically all the T accounts that we looked at earlier, which I drew on a piece of paper and showed you. And we then consolidated that information into the trial balance to construct a number of financial statements. Now, what we have covered today is essentially the basis of what we will be covering next week when we look at adjusting entries. So it's very, very important that you understand how to record these transactions and then how to consolidate them together through the T accounts and trial balance so we can cover next week's workshop.